Hello, everyone. I'm now preparing a tape to replace our class meeting from Monday, April the 5th. So let me go ahead and share the screen and I'll get started. So basically what I'm going to talk about is really the same thing we would have talked about had we been in class. And we're on chapter 10 now. So we will not meet this Wednesday. You'll have a separate recording for this Wednesday's class. But basically, chapter 10 is long term liabilities. And basically, long term liabilities, the main thing is bonds. Now, bonds are a form of long term debt. And one thing to remember, long term liabilities are any liabilities or any debt that basically the company is going to take longer than a year to pay off. So that's a long-term liability. Any debt the company is going to take longer than a year to pay off. Typically, the main one you see would be bonds payable. The company could also have a long-term note payable, like maybe a 5-year note or something of that nature. Sometimes you'll see a mortgage payable, which would be like on a building or significant property. And typically those are 20, 30 years in length. So bonds payable are really one of the main ways that companies raise money for their business. So basically, what bonds are is a company sells debt to the public for cash. They sell debt to the public for cash. Now, who typically buys bonds? Individuals, some. A lot of them are sold to other companies or other corporations. They buy the debt of other companies or other corporations or retirement funds. A lot of retirement investors will put part of their investment in bonds. Typically, I put a small part of my investment in bonds. So that's not out of the ordinary at all. So when it comes to bonds, what happens here is the company gets cash and the bondholders, which is the name of those who buy the bonds, gets regular interest payments, typically either once or twice a year. Most bonds are twice a year, semi-annual. And then the bonds will get the principal or the face value of the bonds back at maturity. Now, maturity is basically whenever the bonds expire. Like if you've got a 5-year bond, you're going to make regular interest payments to the bondholders, either once a year or twice a year over the bond, over the life of the bond. And then at the end of 5 years, the bonds will be paid back. The principal or face value of the bonds will be paid back to the bondholders. So the company gets cash and the company gets to then invest that cash back in their business. The bondholders get regular interest payments and then they get their principal back at maturity. It's really a good arrangement because everybody gets what they want. The company gets cash to build their business. The bondholders get interest. They get a return on their investment. And so everybody gets what they want. Now, a couple of things here. Bonds are a form of debt financing. And probably one of the biggest advantages of them is that they offer a low rate of interest. Interest rates are low right now, so they're paying low amounts of interest now, and they get to write off the interest on their taxes. So that makes it even cheaper that they get to write off the interest on debt on their taxes. So that makes it pretty cheap. That's a big advantage of debt financing. Now, so debt financing is really probably the cheapest way that a company can finance growth. The exception being reinvesting their profits, which would be really the cheapest way. Now, probably the one disadvantage to it is that companies need to make sure that they don't take on too much debt. Because just like an individual, if a company takes on too much debt, the payments are due regardless of how well they're doing financially. If they're having a good year, having a bad year, interest payments are still due. So a company can really take on too much debt. It can become risky or too risky. The cost of their debt can go up, and so companies do have to watch how much debt that they take on. Typically, most companies think the average U.S. company about 50 to 60% of their growth they finance through debt, and that's acceptable. Um, some foreign companies, Japanese companies, will get up to 90. So it does depend on the company, but one thing to consider is that The downside to debt is the payments have to be made. If a company were to finance more through stock, it's going to be a little more expensive because you can't write off dividends. But if things go bad, you don't have to pay dividends, or you're not required to pay dividends. So dividends can be a little safer way um, to basically for a company in some cases. So it does require regular interest payments. Now, some terms related to bonds. You could have serial bonds. And what serial bonds are is this is a case where the company that issues the bonds has to pay back the principal over the life of the bonds. So instead of paying back the principal at the end at maturity, they would have to pay back, like, let's say if it's a 10-year bond, they might pay a tenth of it back every year. It really is kind of more of a security thing. One thing to think about is when companies issue bonds, um, the majority of bonds are really only backed by the good faith and credit of the company that's issuing them. So, in some cases, investors might want serial bonds, or might require serial bonds, or companies might need to issue serial bonds to appease investors because they would get back their principal over the life of the bonds, which is a little safer for the investors, the bondholders. The bondholders are the investors that purchase the bonds. Remember that terminology. Now, another thing here, companies have bond ratings. A AAA would be the highest, and then they would go down from there. You see some of the ratings. I got, you know, um, triple B, and there's a couple of different bond rating agencies that do it a little differently. But one thing to kind of think is that typically once you get to C or D and below, you're kind of looking at junk bonds, which are very high risk, very high interest bonds. But the higher the bond rating, typically the more safe and secure those companies' bonds are, or there's just less chance that the company is not going to be able to pay them back. So bonds rating, almost a little like a credit rating for an individual. Now, they do have the New York Bond Exchange. So anyone who's a bondholder, whether it's a corporation or another company or mutual fund, can sell their bonds in the New York Bond Exchange. So the New York Bond Exchange is a lot like the New York Stock Exchange in that it's a secondary market, but instead of stocks, they sell bonds. So you could sell your bonds or buy bonds there from other individuals, and it's a secondary market, much like the again New York Stock Exchange. Junk bonds, I mentioned those earlier. These would be typically younger companies that maybe have a lot of debt, that are higher risk, that have had poor financial performance, and they need cash to keep their business afloat. They need cash to maybe try to build back their business or build up their business. And so their bond ratings would be lower because they're greater risk. And in turn, they're going to have to pay a lot higher interest rates to get bonds. Remember that again, bonds are backed really only by the good name of the corporation that is issuing them. So the riskier the company, typically the higher the rates of interest they're going to have to pay on their bonds. So if a company reaches junk bond status, they might have to pay 20% interest on their bonds. There's a thing in finance that basically when you take financial, you'll see this, and that is that the risk must match the reward, or the reward must or the reward must match the risk, maybe a better way to put it. But the higher the risk, the greater the reward. So investors, before they're going to take a greater risk, must get a greater reward for taking that greater risk. So that's why they typically come with much higher rates of interest. More of them might be serial bonds where they have to pay back the face value of the bonds over the life of the bond instead of waiting till the end. So a lot of protection, a lot of things to protect the bondholders, basically, or to, basically to higher rates of interest, higher returns, things of that nature. Now, for bonds selling at par, let's say a company issues $100,000 bond at par. Now, bond selling at par, what this means is that the bond is going to sell at its face value. Now, face value is the value that's on the bond. So if it's a $100,000 bond, it's going to sell for $100,000. Now, there's different instances. We're going to look at one in a moment where bond sells at a discount, which is less than face value, or a premium, which is more than face value. But in this case, we're looking at a bond that sells right at face value. So in this case, we would debit cash and we would credit bonds payable for the amount of for the issuance of bonds. So in this case, the company's debiting cash because they're getting $100,000 cash that they can reinvest back into the business. And they're crediting bonds payable because they have to pay this amount back once the bonds mature at maturity. Now, let's say the bonds pay 6% interest semi-annually. And most bonds you're going to see pay interest semi-annually. It just means twice a year. Every 6 months, they're going to pay interest. So what we would look at here is we'd want to figure the amount of interest. And basically, we would just take the face value of the bond times the percentage of interest, and then we would divide it by 2 if the payment's made semi-annually. So in this case right here, it's going to pay $3,000 interest per year. So our journal entry to record the interest would be a debit to bond interest expense and a credit to cash. That would be the journal entry that we would do here. And then these bonds are 5 years. So when the bonds mature, the company has to pay back the face value to the bondholders. So basically, notice the journal entry they would do. They're basically reversing the entry they did whenever they first issued the bonds. They're going to debit bonds payable. They're going to clear that liability off their books. They're going to credit cash, and they're going to pay back the face value of the bonds to the bondholders. So in essence, think about it this way. The bondholders have received interest payments for letting the company have those funds for a period of time that the bond's covered. So if it's 5 years, the bondholders give up their cash for 5 years. They get it back in 5 years, but they get interest payments for giving up their cash over that period of time. Like I said, it's really an arrangement that really helps both parties. The company gets cash to do what they need to do. The investors get a return for their cash. So I guess, again, it benefits all. Now, one important thing I kind of wanted to say here before we get into discounts and premiums, which are the next two we're going to cover, and that is there's kind of a summary here. And I bolded these because these are important to realize and important to know. And that is, if the market rate of interest is equal to the bond interest rate, then basically the bonds are going to sell at par. Now, what this means is if similar bonds in the marketplace are selling at 6%, and my bond is paying 6% interest on it, my bond is going to sell right at face value. And so because my bond is paying the same interest as they can go somewhere else in the marketplace to get, so it's going to sell it at face value. Now, but what if the market rate of interest is greater than what I'm willing to pay on my bond? So what if the market rate of interest for similar bonds is 6%, but I'm only paying 5% on my bond? Then basically my bond is going to sell at a discount. And basically what this means is that I'm going, since the market rate is 6% for similar bonds, I'm only paying 5%. Why would investors buy my bond? They can go out and buy someone else's and get 6%. Why would they buy mine and get 5%? And so what I have to do is I end up selling my bond at less than face value in order to get a buyer for my bond. I have to sell it at a discount. So a discount just means that I'm going to receive less than face value for my bond whenever I sell it, but I'm going to have to pay back the face value. That's something we'll talk about when we get into discounts and premiums in a moment. Now, what if the market rate is less than what I'm paying on my bond? What if the market rate for similar bonds is paying 6%, but my bond is paying 7%. Then investors will really want my bond because I'm paying a greater rate of interest than they can get anywhere else. And so in that case, my bond is going to sell at a premium, which means I can get more than face value for it because they're going to get a greater rate of interest when they get my bond. So they're going to have to pay a little bit more for it over face value. Now, I'm only going to have to pay them back face value when the bond matures, but I'm going to get a little bit of a premium, I guess you could say, over face value for this bond. So keep that in mind. Now, let's look at an example of a discount. Now, let's say that we've got a bond here. And this bond is 100,000 face value. It's selling at 97. Now, what you're going to see for bonds is a lot of times they're going to say sells at 97. What that means is that it's selling at 97% of face value. So like in this example here, if it's selling at 97, we would take the face value times 0.97, 97%, and we would get 970,000. So that would, or excuse me, 97,000. So that would mean this bond is selling at a discount. A bond that sells at a discount is selling at less than face value. Now, the interest rate is 6%. The semi-annual interest, we would take 6% of the face value. You always base interest off the face value and then divide it by 2 since we're paying it twice a year. So that would give us basically $3,000 every 6 months worth of interest we're paying. The length of the bond is 5 years. So the journal entry that we would make to record this at issuance would be that we would debit cash, in this case for 97,000, because that's the amount of cash we're receiving. When we're doing the journal entry at issuance, we're always going to debit cash for the we're always going to debit cash for the amount of cash that we receive. That's what we're always going to debit cash for. Then we're going to debit discount on bonds payable for 3,000, which is the difference between that and the face value. And we're always going to credit bonds payable for whatever we have to pay back, which is the face value. So we always debit cash for what we receive, the amount of cash we receive. We always credit bonds payable for the face value because that's the amount we've got to pay back when the bonds mature. And in this case, we would debit the discount on bonds payable for the difference between what we receive and what we pay back. Now, in this case, it's a discount because we received less than the face value for these bonds. Now, this is what it would look like on the balance sheet. We would have bonds payable for the amount that we're going to have to pay back, the face value of the bonds we just issued, less the discount on bonds payable. Now, the discount on bonds payable is a contra liability account. Now, what a contra liability is remember, it's an account that's related to another account, in this case, a liability, but it has a balance just the opposite of the account that it's related to. So in this case, a contra liability account. Now, the carrying value of the bonds is the difference between bonds payable and the contra liability for discount on bonds payable. This would be the amount that the carrying value is the amount that we initially received for the bonds. So this is what it would look like on the balance sheet, basically after we issued these bonds. Now, we're going to do something here called straight line amortization. And here's what we're going to have to do. We only received 97,000 when we issued the bonds, but we're going to have to pay back 100,000 whenever the bonds mature in 5 years. So we're going to have to amortize off that discount over the life of the bond to where the carrying value of the bond is equal to bonds payable, or what we're going to have to pay back when maturity hits. So let's look at this. So under straight line amortization, at first interest payment, what we would do is we'd come up with, okay, what's going to be the amortization of the discount? We're going to amortize it every time we make an interest payment. And what we're looking at here is straight line amortization, which means that we're going to take the total amount of the discount, we're going to divide it by the number of interest payments that we make, and that's the amount that we're going to amortize every time we pay interest. So in this case right here, what we're going to do is our number of interest payments is going to be 10. It's a 5-year bond, and we're paying interest twice a year. So that means we're going to make 10 payments of interest over this 5-year bond. And so what we do is we take the total amount of the discount, which in this case is 3,000, and we divide it by the number of payments. And so we're going to amortize this discount off at $300 every time we pay interest. And so, and it's going to be the same payment in the same amount every time we pay interest. So let's look at this one. So notice we would debit bond interest expense, in this case for 3,300. Now, remember we're using the same numbers that we did in the last example. So basically our regular interest payment to bondholders would be the same as what we did in the last example, which would be 3,000 per every 6 months, 3,000 every 6 months. So our debit to bond interest expense is the 3,000 that we're paying interest to the bondholders plus the $300 worth of discount that we're amortizing off with the payment. Now, notice that we're going to credit discount on bonds payable for 300. Now, we did that because remember when we did our initial journal entry, we debited all of the discount to discount on bonds payable. So if we want to clear that out to zero by the time the bonds mature, we're going to credit that account every time we make an interest payment for the amount that we're amortizing. Now, notice our credit to cash here is for the amount of cash or the amount of interest that's being paid to the bondholders. So with every interest payment, we're going to have a debit to bond interest expense that's going to include what interest we're paying to the bondholders plus the amount of the discount that's being amortized each interest period. And then we're going to take off or we're going to credit or reduce the amount of the discount on bonds payable account each period by, again, by whatever amount we're taking based on the number of interest payments divided by the discount amount, straight line amortization method. And then our credit to cash here is always the amount of cash that's being paid to the bondholders for their regular interest payment. That's going to be consistent. Now, at the maturity of the bonds, regardless of whether we issued the bonds at par, regardless of whether we issued them at a discount or a premium, the entry is going to be the same. We're going to debit bonds payable for the face value of the bonds, and we're going to credit cash for the face value of the bonds. And so we're clearing off the liability by debiting the liability, and we're crediting or reducing our cash because we have to pay back the face value to the bondholders. So whatever happens, whether we issue them at par, a discount, or a premium, this entry will be the same every time. Debit the payable, debit bonds payable, credit cash, and then we send that money back to the bondholders. Now, what if the bonds sell at a premium? So what if we had a case where we had some bonds, they're $100,000 face value, and basically all this information is very similar to the other examples we looked at. Let's say that these are selling at 103. So what that means is we would take the face value times 1.03 or 103%. And in this case, we're going to get 103,000 for them. Since we're getting more than the face value, these bonds are a premium. Our interest rate 6%. Now, if we wanted to figure our semi-annual interest, we would simply take the amount of interest times the face value, and that would give us basically semi-annual interest of 3,000. So the length of the bond is going to be 5 years. So what that would mean is our journal entry at issuance would be that we would debit cash for the amount of cash that we're receiving, which is 103,000. We would credit bonds payable for the face value of the bonds. We always do these two parts of this journal entry. And the difference in this case would be a credit to the premium on bonds payable account because we received $3,000 more than the face value of the bonds. These bonds were issued at a premium. Now, what this would look like on the balance sheet. what this would look like on the balance sheet, basically. Is that on here? I don't think I did. Let me go down. Let's look at it on the balance sheet. Basically, what this would look like on the balance sheet is we would have bonds payable again at the face value, what we're going to have to pay back. We would add the premium on bonds payable, which is 3,000, and our carrying value of the bonds would be the bonds payable plus the premium would equal the carrying value of the bonds. Now, the premium on bonds payable account is an adjunct account. Now, you've not had an adjunct account in this class yet, but an adjunct account is an account that's related to another account, but it has a balance the same as the account that it's related to. It's different than a contra account, like we looked at with the discount account, where the contra account is related to another account but has the balance just the opposite it's related to. An adjunct account is related to another account, but it's a balance the same as what it's related to. So, so let's look at our first interest payment. So we're going to have to amortize the premium in the same way that we amortize the discount, because we received 103, but we're only going to have to pay back 100 when the bond matures at maturity. So the premium amount is 3,000. The number of interest payments is 10. Again, 5 years, 2 payments of interest per year. That's going to be 10 total payments of interest. So we would take that 3,000 amount of the premium, divide it by the 10 interest payments, and we would have basically, again, $300 per interest payment. And again, we're using the straight line method of amortization. We're looking straight line amortization here. Now, at the first interest payment, this is how we're going to make the first payment of interest. Again, our amount of interest is the same as what we looked at in the last example. We're going to take the face value times the 6%, which is going to give us 6,000 per year. We're going to divide that by 2. And so we're going to get $3,000 of interest every 6 months. The same here as what we looked at in the last example. Really, the other 2 examples, really. So the amount of our bond interest expense here that we're going to debit is going to be for the amount of interest that we've got to pay to the bondholders, which is 3,000, less the amortization of the premium, which is 300. So that's going to be a debit for $2,700 to bond interest expense. Now, the debit on premium on bonds payable is going to be 300. The debit on premium on bonds payable is going to be 300. Which, remember that we initially credited the premium on bonds payable. So as we're amortizing it off, we're going to debit it and reduce the premium again over the life of the bond. We're going to amortize it down or amortize it off. And the credit to cash here, again, is for the amount of money that we're paying to the bondholders for interest. So this is how we would handle it. The premium reduces the interest expense that we're recognizing whenever we pay interest. Remember, the discount was added to the interest expense. The premium reduces the interest expense that we're recognizing whenever we make an interest payment. Now, at maturity, basically we would debit bonds payable, we would credit cash, and basically at maturity, what we're doing is we are basically doing the same entry as we did with the discount and the par, what we looked at a moment ago. And basically we're clearing out the liability by debiting the liability, and we're crediting cash because we're paying out $100,000 cash to the bondholders. We're paying back the face or the principal value of the bonds.